Hello, thank you all so much for joining in on the recorded presentation today. We have just a few basic topics to go over with you guys, and I wanted to provide some information and some content that you can watch at your convenience, whether that's on your phone in the evening or maybe over the weekend as we gear up towards the enrollment time for 401k plans. For those of you that have not had the opportunity to meet, my name is Alexis Pig with 6 Degrees Wealth. We are the advisor on the 401k plan. We're very happy to provide educational content just like this to your plan, as well as information and oversight of the investment menu. So that's a very heavy role that we play, is the investment options and management of that menu for your plan. But also we want to provide resources and education around the 401k as well as other financial topics. So after you watch a recording today, if there's any other things that you may have interest in, topics you would like to learn more about, please don't hesitate to let me know, let your plan sponsor know, or the owner of your company, whoever sent this video to you. We would love to get feedback and create additional videos for you guys in the future. So today our topic is a simple introduction to investing. This just is a nice high-level overview of investing versus savings. Now, some of this can be applied to 401k, but it can apply to other types of investment accounts. And so we'll talk about some specific examples as we get into the content. Savings versus investing. One of the main things that differentiates these two topics is the time horizon. So think about a savings goal, something that's very short term, something that can be easy access to, something that you have maybe a savings account in a bank or an emergency fund. If unfortunately something were to happen and you needed to get your hands on an amount of cash, where would that be? What are some options of ways we can set that up for you? On the other side of the coin would be the investing column. So think of a longer term time horizon. Your goal is farther away, more of a distant goal at this point. So things like retirement lifestyle, things like looking to children's education. Sometimes you start planning for those 10, 15 years in advance. Retirement lifestyle, hopefully we're starting to plan well in advance of that goal being here. So these are different time horizons, and when we're looking at what's the most appropriate way to invest those dollars, time horizon and the purpose for that money is a big factor that we want to talk about first. So this gives some examples of those two categories. Safety, thinking about emergency fund. Again, you want to have something you can get your hands on pretty quickly. That would include cash, T-bills, money market accounts. Those can be liquidated quickly, and then either have a check writing capability for some sort of bank accounts, or something that can be sent to you pretty quickly. Again, the trade-off with this would be the average annual return. It is very conservative, very safe, but it is going to have a lower on average return, which is not a good thing, not a bad thing. It's just something to be aware of. And when we're looking at investment choices, what are those trade-offs? What are the pros and cons of the different options we have available? So investing, again, this is more of the long-term goal. These are things like saving for education expenses, really accumulating wealth. Is this in a trust account? Maybe something that you want your children or grandchildren to inherit one day. Long-term goals, we use more stocks, bonds, mutual funds, real estate, and a lot of things that you can hold for a longer period of time to achieve those bigger goals. And think of this again as that accumulating wealth, saving for retirement type investment accounts. The average annual return, now again, this is just a very simple summary, different types, stocks, bonds, mutual funds, they're each going to have their own average, and we can get much more specific about performance. But just for a simple illustration, this is listing an average annual return of about 6 to 10%. So that's just looking at stock market historical averages. But that would be one of the benefits of more investing type vehicles. They are going to have more volatility along the way, some bumps in the road, but the average growth potential is much higher for those types of investment vehicles. So again, not a good thing, not a bad thing, just some trade-offs that we want to be aware of. And that's, where we can come in, our team, as a resource and be helpful to you as an investor. What are your goals? What is your priority? How would you like these funds to help you? And then we can work through those options and talk about, what your purpose is for these accounts and how do we set up investments that are appropriate for you, whether that's things that are more savings type accounts or things that are more traditional long-term investments. So most families, most households have a combination of these two. It's just a matter of what funds and what's your purpose for those funds. So this is a nice simple graphic that just shows the opportunity of money over time. So again, the orange is that savings growth. Now it's pretty much a straight line across the bottom. You would have some upside, in money market funds, things like that are actually having pretty good performance at this point, just because of higher interest rates than traditional averages. So it would be growth, but it would be very steady, consistent growth. But looking over time, you can see the purple with that investing mark. How does that provide for growth potential over the long term? And this graph shows, 40-year time horizon. That may be somebody that's 20 years old that starts investing in their 401k. If they have a investment portfolio that's 40 years of a time span, they have had a lot of opportunity for growth and a lot of performance just compounding over time in that 401k account. So you can see the difference between something that was invested, maybe a mix of stocks and bonds, that's over $20,000, versus, or, just in this example, something that was $2,000. It's much larger returns and much more opportunity for growth. However, there's still more risk involved with the investing types of vehicles. So some topics here that are helpful just to highlight, thinking about your retirement account, specifically the 401k, we want to have a long-term focus for those dollars. How can we take advantage of compound interest? So again, think of compound interest as that snowball just rolling downhill. As it gains momentum, you're earning interest on previous interest payments that have come to you, or growth on previous years of growth. So just again, that momentum and that snowball rolling downhill that can really make an impact over a period of time in an account like a 401k, where you're holding those investments for many years. Don't be tempted by market distractions. When you have volatility and ups and downs in the market, that can often be a really tempting time to say, oh, I'm nervous. A lot of bad news reports are going around. I prefer to sell everything and just sit on the sidelines. Sometimes that can be terribly detrimental to an account. So instead of, being tempted by the market distractions, have a conversation with us about what's the best place to put you on your investments. Having those continuous performance reviews with us, financial planning with us, we can come back and say, okay, here's a way we can adjust it. We can make some, rebalancing recommendations to you, just small tweaks, and you're not selling everything and totally sitting on the sidelines. You're still in the market. We may just pick something that's more conservative if there's something that you're worried about. So it's just making those simple edits and small dialing up or dialing down instead of just a complete sell everything and get out. So timing the market, this is an important slide that really highlights what we just spoke about, the temptation to sell everything and get out. So looking at over a period of 1996 to 2015, this shows the S&P 500 index. Now, this is a very traditional stock market index that's used to track the market. A lot of people are familiar with this. So if your account was in the S&P 500 index over that period of time, you would have had an average of 8.2% in annual returns, which is pretty great. I think everybody would be happy with that. However, if you had missed the best 10 days of that performance, you'd be cut by half. So it makes a huge difference. You think of that long time span that you were invested in the market, just 10 days could cut your performance in half. 20 days cuts it down to 2%. So, even just a very small fraction of the days, if you miss those best performing, those rally when the market really comes back strong, it has a huge impact on the overall average of your returns. So that's why it's helpful if you have concerns or you're not sure if you're in the right spot, you just want somebody to review this, kind of have a recap with you, let us be a part of that conversation. We're happy to help. We want to make sure that you feel comfortable with your investments, but also you're not tempted to make rash decisions and make huge adjustments in your 401k account when there may be some ways to just make small tweaks, small adjustments, and help you keep that upside growth potential. What is risk? So this is a nice way that just looks at, again, that long-term time horizon. So this is focusing more on things that are retirement-based goals, that wealth accumulation, that you're holding an investment portfolio for a long period of time. So this graph uses 1990 to 2018 as an example. In those small pockets, you can see the orange circles. It's showing extreme volatility. 2008, 2009 was definitely something that a lot of investors remember. However, if kind of scaling back, looking at the full time span, what the growth potential was over that period of time. Now looking for, a month, a quarter, maybe even a year, there were many years where that performance was negative. The portfolio actually lost in value. However, looking at the long-term time horizon, it's worth it because at the end of the period, your account is up drastically. So instead of thinking about, okay, what has it done today? How much risk am I feeling comfortable with because I know I have the luxury of time. Using those long-term time horizon, that's a huge benefit for a participant in a 401k account. So how do we help you find something that you're comfortable with, but also will give you growth potential to support your retirement lifestyle? And so this just shows some examples you can see on the slide of stocks and their returns versus bonds and some of the performance in those years. So risk tolerance, a word that's often used is asset allocation. So asset allocation just means the mix that's created for a specific portfolio or a specific account, or maybe even referring to an investor, an individual. What is your proper asset allocation? So a lot of times the basics will be stocks, bonds, cash. There's a lot of different things that can be put into asset allocation mixes, alternative investments, private equity. We can get really specific and a lot of different categories all mixed in, but just think of it as that pie chart. So what is your risk tolerance? How much are you willing to have exposure to certain categories of investments? And here in the infographic, it shows you, taking on too little risk, you may not make enough headway. So, some of that illustration we looked at before, when it was the orange line was just almost straight across the bottom. It was very conservative. It didn't lose money, but also it didn't grow very much. So throughout your career, if you've been saving and contributing to a 401k, if you don't take on any risk at all, it could just be a flat line, and that savings has not benefited you by growing enough to support your retirement lifestyle. On the other side, if taking on too much risk could cause some pretty drastic swings in your account. It could make you really uncomfortable and make you nervous about your investment. So where is that happy middle? And it's different for every participant. There's not a one-size-fits-all. That's why we have choices of the investment menu. That's why there's a wide variety of what we can do as far as target dates or things that are based on, conservative, moderate, aggressive, things like a risk profile, or even options that you create your own mix. You select how much you want in each individual mutual fund. So we're here to help you navigate those conversations. That's what our team does. all day. We have conversations with our clients and with participants to help them find the most appropriate investments for them as an investor, because it's a little different, it's a little unique, just based on your goals. What's your personal situation? And so that's where we're here to be a resource for you guys. Good investing is boring. I thought this was kind of a funny little slide that showed, just some very, very helpful truths of the 401k. The best things that we can do in our 401k plan is consistency, just contributing early as much as you can. If you're brand new to 401k, or maybe you haven't contributed yet, you're not really sure if this is a good fit for you, I encourage you, even if it's small, to get started. It's very helpful to have the power of consistency of those contributions and the power of time. Even if it's small growth, if the things like the money market, the stable value types investments, if those are really more comfortable for you, that's okay. Go ahead and start those contributions. Every little bit counts. So then you can get that snowball starting to roll downhill. So in this image here, it just shows, I don't try to jump over the 7-foot hurdles. I look for 1-foot hurdles that I can step over. So 401k is definitely looking for those 1-foot hurdles. We're not swinging for the fences. We're not trying to pick the stock of the year. We're using quality, consistent investments that you can hold for the long term. And if you're not sure about the different choices that you have, use us as a resource. That's what we're here for. But everything in your menu within the 401k is a quality, consistent piece. So it's really a matter of, picking of all the choices, they're all good choices, what's the best for you as a participant? And just being consistent with using the payroll, whether that's every 2 weeks, every month, however that falls for your company, using that as a benefit of just consistently making those contributions over time. Investing should be more like watching paint dry or watching grass grow. Again, just the consistency makes all the difference with 401ks. So here's my contact information. You guys can see on the slide. Please reach out to us. Again, we're happy to help. We would love to have these conversations. If you have any questions on your investment menu or what's available to you through the 401k plan, please reach out to me. In this information that you'll be getting, you'll also have details with your record keeper and how to enroll. And usually the record keeper website is the best place to get started to actually enroll and begin participating in your 401k plan. But there's going to be some extra information when this video is sent out to you guys. So again, please feel free to contact me with any questions, anything we can do to help as we begin this enrollment period. And also, as we go to next quarter, please send me feedback on what topics you would like to see. What would you like to learn more about so we can create videos for next time. Thank you all so much, and I appreciate you joining.